Hello everyone, we're going to review the answers to Chapter 5 for our homework, specifically on itemized deductions. We're going to start with number 2, a whole list of things, and you were to determine whether they were deductible for the medical expense deduction or not. I have indicated here whether they are, the amount, if it is deductible. What's the premium on health insurance deductible, life insurance not, accident insurance not. Acne cream, there's technically not enough information here to know for sure, but if you assume that it is over the counter, it is not deductible. If there was a prescription and this was a prescribed acne cream, then it would be deductible. That would be the difference. So that there are your prescriptions in 5. Again, vitamins, even if this is kind of a situation where if the doctor said you should take more vitamin B, that's not going to be deductible. But if he gave you a prescription for a specific dosage of a particular vitamin or something like that, then that would be deductible. So it kind of depends on how that is communicated, kind of splitting hairs there. Cosmetics, no. Anything cosmetic. Dentist, yes. Health spa, currently not. Okay. Every once in a while I think that that's going to change in the law, but it hasn't so far. Some of these others deductible. Remember, the general rule is it must be used to treat a specific illness or condition. Okay, mileage, 18 cents a mile for 14. Nothing illegal is ever deductible. So illegal drugs. So of course you're into the situation where is marijuana or cannabis as a treatment, a prescription deductible, depending on which law you look at, whether it's allowed or not. So that one's an area that no one knows the correct answer for yet. Surgery, wheelchair, used or new, doesn't matter. False teeth, sort of thing, all deductible. But remember, you have to add all this up, and only the amount by which it exceeds 7.5% of AGI is the amount you would actually be able to use as an itemized deduction. So it's pretty restrictive, and then it has that threshold that is pretty high. We're going to move on to 6. This is where people get in trouble with taxes and how much is deductible. Remember, it is the amount paid for state and local taxes, not federal taxes. And so don't forget the amount that was paid with the return. And you notice it's deductible in the year that it is paid, not the year that it applies to. And then the refunds are taxable if you itemize the year before. All right, so if you didn't itemize the previous year, then any tax refund you got no tax benefit, so you do not have any, and that's the situation in B and C. Federal refunds are never taxable. All right, 7, another, looking at what is deductible, all the amounts paid, and the refund does not affect the tax expense, itemized deduction. That you don't offset them. It becomes included in income while the payments are a itemized deduction. Again, only the amounts paid in the particular year, regardless of what they apply to. Okay, interest on homes. You can up to 2 homes, up to $750,000 under the new tax law. You pick the main home, right, and then the paid in the other home would be the best way to choose. However, if you have paid off your main home, you only get one vacation home, and so you pick the highest one. All right, for 13, this is a investment interest. You have an important decision to make whenever you have investment interest. If the investment interest, because that investment interest is only deductible to the amount of investment income. However, you can define investment income in two ways. It can be you can leave out capital gains and qualified dividends. Then you would only be able to deduct $2,400 of your interest paid to offset the $2,400 of taxable interest income. However, if you count those other items, then you can deduct up to $10,700. However, then you do not get to use the lower tax rate on capital gains and qualified dividends, and that could be as low as 0 depending on your tax bracket. All right, any amount that's not deductible is carried forward. So that's a decision that you'd have to look at it both ways to see what the best option is for the taxpayer. Introduction, different types of interest. The ones that are deductible are the new mortgage and the interest paid on the corporate bonds, because he actually had $5,000 of interest income. So he would be more interest income than interest expense. The others are not deductible. All right. The home equity loan is non-deductible now in 2018. That is a change in the 2018 tax law. 16, again, we're talking about whether it qualifies as a deduction. Now we're looking at charitable contributions. Notice some things about if you just pledge, it's not deductible until you actually pay it. 16C is deductible, but not as a contribution, just that you reimburse your employee. It's just regular expense for the business. Political contributions are never deductible, and your deduction, you do not get a deduction for your time. The amount that you do not get to calculate the value of that time and take a deduction. That is not allowed. It has no value under the tax law. 20 looks at the donation of something other than cash, and we're looking at $15,000 to be used as common stock, a value of $15,000. So because it is a capital gain property and given to a public charity, it's limited to 30% of AGI. You can deduct it at the value of $15,000, but you only can deduct up to $14,700 in this case because of the AGI limitation. Okay, if the stock had only been 6 months ago, that means it's not capital gain property, and thus it is going to, you're going to have to use the cost, $35.75 you paid for it, not the value. All right, 21 is another situation where you spent considerable time that is not counted. Only the out-of-pocket cost for supplies and the mileage is deductible.
This is the Schedule A for Brian Pito for problem 24A. Put our medical expenses unreimbursed, but it doesn't carry over here because the 7.5% of the AGI is higher than the expenses. Taxes are all added up here. Tricky part is what you remember, what is paid during the year to the state. So you've got the 425 plus the amount withheld from wages and your real estate taxes. add up to that, but because of the new limitation, it's only $10,000 that comes over here. Interest, both on the mortgage and then on the investment interest, because he has plenty of investment interest income that exceeds it, so we can deduct that. So the investment interest income went on the rest of the 1040. The investment interest expense that he paid goes here. Our gifts to charity, and then you add it all up to get your total, in this case for the Schedule A. Then for problem 29B, Maurice Pryor, the Schedule A should look like this, very similar to the earlier one example. No medical expenses were given. You did have to make some determination as to how the taxes paid, real estate, local, personal property taxes all add up. But because Maurice is filing separately, he only gets a maximum of 5,000 taxes. So really, all this adds up. Doesn't help us a whole lot in terms of that. Notice that Social Security, Medicare are not included. We're only counting here the state income taxes that are either paid during the year or withheld from the checks during the year. Mortgage interest, gifts to charity, straightforward. And then we get to the bottom and add it up to get your total. Let me scroll down here. There we go. There's our total.